Why would you lock up your money for 12 months and pay a penalty if you need to access it early, as compared to putting it in a high yield savings account? The juice isn't worth the squeeze. So while there is the possibility that you have a high yield savings account that's paying you 5% now, and 6 months from now, it's only paying you 4.5% or 4%, I would much rather you have the ability a month from now or 2 months from now to be able to access all of that money when needed, as compared to trying to figure out a penalty that you would owe by accessing a CD early. But that doesn't answer the question of why is a bank pushing this in the first place? Because to me, and I actually have talked to some banking friends about this, it doesn't make sense. And I'll tell you why. If you look at how a bank makes money, it gets a little more complicated than this, but bear with me. This is basically the crux of how a bank makes money. You give deposits to a bank. A bank then takes those deposits and they lend that money to consumers of the bank through lines of credit, through mortgage loans, what have you. And the goal of that bank is to receive more interest on the loan than they are paying you out in deposits. So, for example, if you have a lot of loans that on average are paying you 4%, and you're only giving out 2% interest to your depositors, then you're getting a 2% spread on the money the depositors gave you that you then turned around and loaned out to your customers. But here's the thing. Banks can make money on high yield savings accounts, but it's not guaranteed. Let's go through a scenario where you might have a bank that has a lot of old loans on the books from 2019, 2020, 2021, where those people who borrowed money are only paying 2.5, 3.5% on the loans that are coming back into the bank as revenue. But a bank has a high yield savings account at 5%. So they're making 2.5, 3, but they're giving out 5% in interest. There is the possibility that they could lose money on a high yield savings account. It doesn't always happen. They sometimes keep that spread and they're profitable, but it is possible to lose money on that savings account. So to me, when I'm thinking about it, I'm like, well, you have a high yield savings account at many banks that are not promoted very strongly. As a matter of fact, I typically have to ask clients, hey, they told you to put your money into a CD. Did you even ask them if they have a high yield savings account? They go back to their bank and voila, their bank has a high yield savings account that they never told them about, but they did push them into a CD and told them to sign up as quickly as they could. That doesn't make sense to me because at least, like I mentioned with the high yield savings account, if interest rates go down, they can just lower the rate of interest that they're giving to their depositors. But when a bank offers a CD, that's a contract. When they sign someone up for 12 months and they tell them that they're going to pay them 5%, they have to pay them 5%. So I'm wondering, how does this make sense to the bank? And then I reached out to a friend of mine. I did not ask for his permission to identify him, so I'll just read what he sent me instead of sharing his name. So he first said, and I quote, banks don't always lose money on high yield savings accounts, but when interest rates spike very fast, the margin between interest paid to depositors and the interest earned on fixed rate loans can compress quickly, which challenges profitability. That's where I'm talking about, where it's like the rate shot up on the high yield savings account, and all of a sudden you are costing yourself a lot of money to your depositors, but you're not making as much of a spread when it comes to your loan revenue. He said that's certainly been the case in the basis point spike we saw in rates most recently. In addition, depositors had more options for yields in terms of short-term treasury notes and other investments that have shifted balances from banks to these other investment vehicles. So while the rate environment is a challenge, maintaining liquidity has also been a challenge. So that's why you still see the aggressive rates, end quote. Let me break that down in layperson speak. What he's saying in this: yes, it's a possibility that you could lose money on a high yield savings account or a CD, but it's not guaranteed. But when you look in this interest rate environment, when you have banks closing like a Silicon Valley bank because they did not have enough in reserves, then if you're a bank, you're facing a potential profit crunch, but also a potential liquidity crunch where you may not have enough reserves to meet your obligations.